I'm going to dive you into the shallow end of the fundamental analysis pool today, and I have a very good reason for doing so. We all know, for example, that the markets have been largely range-bound since the end of last year, since the end of 2014, and the S&P really sitting on a very wide range, greater than 5% from the top to bottom of that range. It's getting harder and harder, I think, for many investors to find good stocks to buy. And I am going to be talking about stocks this morning, and specifically what I'm going to be focusing on is helping you find good stocks to buy, largely predicated on the purpose of owning them for short periods of time with some specific profit targets or profit gains in mind. So with that, I'm going to introduce what we call our fast gap, PE gap training. None of this will make sense for the first few slides, so just bear with me as we get going, but it will in just a couple of moments. And briefly, let's talk just real quickly some high-level points here. Some of the things that I've discovered in teaching and training investors how to build their portfolios, how to take advantage of the markets rather than the markets taking advantage of them. What I keep finding is investors are really stuck in the mud. And some of the issues that they face are chasing sexy stocks, right? Tesla, Netflix, Apple is somewhat of a chase. But what they're not chasing are stocks that have substantial revenue growth opportunities. They typically wind up being forced to wait for technical triggers to tell them when or which stocks to buy. Many investors really are still nervous about buying stocks because obviously the markets not only are at highs, all-time highs, they keep making new highs. And for many investors, you're worried about, am I going to buy the high only to get Charlie Browned again, right? And when Lucy takes the football away every time, investors are nervous about that, and I understand that. But here's where many investors have some other struggles. They don't know how to compound gains or even manage a portfolio of stocks or even build a portfolio of stocks. And what that leads to is too many investors really are using mutual funds or index funds and avoiding individual stocks. And I'm going to be the first, maybe not the last to tell you, but I am going to tell you this morning that owning individual stocks is the best way to still capitalize on the stock market. And I'm not disrespecting, so to speak, options for futures, Forex, etc., but largely in the universe of the stock market in terms of the battle between owning individual stocks and funds that represent them, funds, ETFs, index funds, etc. But here's what you want to understand, and I've got a really cool investment note from a Wall Street banker that will exemplify what you need to find. And to get unstuck, what investors have to be focused on is individual stocks that are moving out of tandem with the averages. Right now we have greater than 55% of the individual stocks on the S&P 500 moving at a rate that's faster than the S&P 500 index in and of itself. That means that there's an opportunity to ride those stocks for gains. But the market specifically, and you'll see this in a moment, wants revenue growth to create that price momentum in those individual stocks, which means the market right now is looking for stocks that are selling at a discount relative to the future revenue growth of the company. Your ability here, what I'm going to teach you, is how to find exactly those stocks and then capture specific profit objectives from those stocks and do this every month. I am not a day trader. I'll say that right up front. At best, I'm a month trader, but more importantly, what I am is a profit objective trader. So I work on profit and loss, and quite frankly, I'll give it to you right now. I work on simple rules called 20-10. I want a 20% profit target versus a 10% loss target. So my maximum loss on a trade would be 10%. My maximum gain would be 20%. So operating at a 2-to-1 risk-to-reward ratio. But let's talk about the investment note. This came directly from Morgan Stanley. I'm sure everybody knows Morgan Stanley. And just follow along with the text on this note. I'm only going to read the first and last paragraphs because they're the only two that really matter here. But in terms of thinking about what kinds of stocks to buy, Morgan Stanley said, a systematic way to think about this might be to look for stocks with reasonably robust long-term earnings growth forecasts that trade at a discount to the market. The opposite, or the flip side of that, would be to avoid names with low expectations for earnings growth that trade at substantial premiums. So your high flyers that don't have that revenue growth to support their high price are the companies right now that Wall Street is looking to avoid. And in the last couple of months, you've seen some pretty heavy movement out of high flyers in tech, in biotech, in some of the more risky or momentum-based sectors of the market. But at the same time, you've also seen some rather robust growth in financials, in food and retail, in companies that have long-term earnings growth forecasts because that's where the consumer is spending the money. So that's where the growth is going to come from. So what we've done is we do this in our program called the Millionaire Blueprint Program, and we've been doing this for a little over 2 years now. We use what we call one number. It is a fundamental analysis number to tell us whether we want to buy a stock, hold a stock, or avoid or potentially sell a stock. And I'm going to teach you this one number process today. It is at best, 2-minute calculation. If you've got a calculator and you can divide and subtract, you can get this number instantly. And as I say, it's simple to use. But what it tells you and why it's so powerful is it will help you know in advance whether a stock has that price momentum potential. This is helping you to find the right stocks to own and avoiding the stocks that you should not be owning. And I'll share with you a little later how you can get your hands on a trading plan with specific rules so that you know exactly how to profit from the stocks that you would buy. But in this one number, and sorry, hang on a second. Here we are. In this session today, what I'm going to teach you is how to get that one number in 2 minutes or less. You'll know whether that stock has that long-term earnings growth potential. And then you'll also be able to identify stocks that are trading at a discount to market value. And that one number is what we call the PE gap. PE stands for price to earnings. This is used for short-term trades or even long-term investments. In long-term, that time horizon is 1 to 2 years, not buy and hold forever. So anything, typically our short-term trades are 0 to 90 days, long-term trades up to 1 to 2 years. What the PE gap will help you to identify, and here are some of the profit triggers or targets that we typically use. Short-term trades lasting up to 90 days for 20% returns. Medium-term trades, which can last up to 6 months with up to 40% returns, and longer-term trades, typically money doubling or better trades. And I'll show you some examples of each of these as we go through. But what the PE gap is, to define it is the difference between a stock's price-to-earnings ratio and its expected earnings growth rate. Remember, our objective here, just like Morgan Stanley's, is to buy growth at a discounted price, which means we need a formula that tells us growth and price. The PE gap does exactly that. It combines both of those fundamental numbers down into one simple number for you to use. What we've discovered, the wider that gap between the price to earnings ratio and the earnings growth rate, the better the opportunity for you as an investor or trader. As I said earlier, you can do this with simple subtraction and division, and we'll dive right into that in just a moment. I'll show you exactly how to get the numbers you need, how to run those calculations, and how to make the potential trades. Right now, I want to talk about, though, are the two components. There are two numbers that you need. The first is the price to earnings ratio, and there's a couple of things about PE ratios. First and foremost, this is a way for you to assess the valuation of the company against its peers, against the sector, against its competitors, against the market. Typically in the S&P 500, we all know that a PE ratio of 16 is essentially considered fair value for a company. Now, you're always going to pay multiples higher than a stock price. You can find stocks that have multiples significantly lower than 16. The problem with the way that PE ratios are expressed in the market today is that they are a rear view mirror number. PE ratios on any financial portal, if you go and look up a PE ratio, it's based on what the company earned in the last 12 months. That's a trailing 12 months or TTM number. That's what I mean by rear view mirror. It's looking backward. What it isn't based on is what the company will earn in the next 12 months. And if we refer back to that Morgan Stanley note, what were they looking for? Reasonably robust long-term earnings growth forecasts. Well, what's a forecast? The forecast is looking ahead, right? It's not looking behind. So why would you use a ratio that looks backwards when Wall Street is looking forward? You won't. In fact, when I get done with this calculation and this little number, you'll never use a backward-looking number again. Now, the way, so again, the way that they're used right now is they're telling you today's valuation. A PE ratio is telling you the valuation of the company today. But you're not buying today's valuation, ever. You should never buy today's valuation. You need to buy the future value of the company, what the company will be worth 3 months, 6 months, 12 months, 24 months from now. When you learn this little formula, what you'll be using is a forward price to earnings ratio, which tells you the future valuation of the company's price. This is how you identify the discount value, so to speak. And it's simplified for you. It's done for you. You'll know immediately whether this company is trading at a discount or trading at a premium. Those are the only two things you need to know. Then when you put together with the earnings growth rate, you'll know whether the company has long-term growth potential. So with the earnings growth rate, this is based on how Wall Street's going to price that stock. It's based on that tomorrow's value concept. But to understand an earnings growth rate, what it tells you is the rate at which a company is going to grow its profits. So you don't want to find slow or no growth companies. Those are your defensive stocks. Those are broken down stocks. You're looking for stocks that have a fast growth potential compared to their current value. So if the prices that are going to move the best or the fastest are going to come from companies that have higher growth expectations relative to that current value. So what the formula will do is simplify the earnings growth rate to an instantly understandable number. The higher that growth rate, the faster the price of the stock can appreciate. And we all know that earnings are a known event, so they occur 4 times a year, and that quarterly reporting, when you learn this little formula, what this allows you to do is to actually stay ahead of Wall Street, because you don't have to run this number one time. You can actually run this number on an ongoing basis, this little formula to always know whether is the company still priced at a discount to future value. Has this little gap that we're talking about, has that closed? Has it narrowed? Has it widened? So what this will allow you to do is to keep literally a running basket of stocks that you can choose from to trade in and out of on multiple time frames, whether it's short-term, medium-term, or long-term. So when you put all of this together, this little formula, it becomes a forward-looking formula for you. The PE gap will tell you whether that company is undervalued today relative to its growth and its earnings growth of tomorrow. And it becomes then a predictive fundamental analysis tool. Now, one of the discoveries we've made by using it is when we find that, and not every stock is going to do this, so caveat emptor on that regard. Understand, though, that when you do find a company that's substantially undervalued, it can often do or ride what we call an escalator move. An escalator move is a very long move up on a chart. It will have you will have pullbacks, corrections inside of that chart. That chart can typically run from 1 to 3 years. I'll show you one in just a moment. But you will see where that stock will pass these little profit posts of 20, 40, and even 100% gains. And it's all predicated on finding that stock that's at that discount at the right point in time. And even today, I know the market's at all-time highs. Even today, you could still find stocks that are significantly undervalued relative to future earnings growth. So here's a chart of Delta Airlines. This is actually a recommendation we made a couple of years ago. So, but it exemplifies, it really shows you what I'm talking about in terms of seeing that escalator move up. So this was at the end of 2013. Excuse me, the end of 2012, heading into 2013, and this is almost a full year's chart just for the year. But you can see how this stock continued to roll up over time. And if you extended this chart out through 2014, you would see that obviously Delta is up in the $40 range now. So this chart actually doubled from here. And it was all based on that one number. At the time that we recommended this, Delta was trading at a forward price to earnings multiple of about 7, which is greater. I mean, if fair value is 16, you already know that you've got a significantly undervalued company, and the earnings growth rate on an annualized basis was in the 20s. So there's a big difference in those numbers. So this is what can happen. Not every company is going to do this. Please understand that. The majority of the time, you will see most of the PE gap companies work in the short to medium term time frames. Probably 60 to 70% of the time is what we find. So in that 20 to 40% gain range. But that, when you put that together and you start trading that way, even if you're trading just a couple of times a month over a couple of months during the year, you can rack up some pretty sizable gains in your portfolio using this process. Remember, not every trade needs to be a big winner. A 20% gain is more than most people ever take out of the market. So that's one of the things that we teach. So here's the calculation. This is the formula. It's the PE ratio minus the earnings growth rate equals the PE gap. So again, you take the PE ratio, you subtract from that the earnings growth rate, that gives you the PE gap. What is then expressed is either a negative or positive number. From time to time, you may find a zero, but for the majority of the time, you're going to find either a negative or a positive number. Now, this is a little unusual because it feels backwards, but when that gap is negative, it means the company is undervalued relative to its earnings growth rate. That's a stock we would want to buy. If the gap is positive, however, that means that the company is overvalued relative to earnings growth, and that's a company that you would want to avoid. You could potentially short it in a very short time frame, but those are essentially the guidelines. You're looking for negative numbers. Those are stocks you want to buy, and then hold in those time frames that I discussed earlier, short, medium, and long term. What you'll discover is, again, these gaps that are occurring will often trigger gains of 15 to 30% returns in short-term investment timeframes. The higher returns occur, again, year to 2 years, but the wider this gap is, the faster that price will correct for you. So here's an example of a small company called Manitowoc. This is a stock that we traded at the end of 2014 in December. At the time, it had a price-to-earnings ratio of 16 and an earnings growth rate of 19. The gap, the difference between those numbers was -3. So it was a negative gap. It was not a huge gap, but they don't always have to be. But because the PE ratio was less than the earnings growth rate, that told us the stock at that point in time was undervalued, and it was a buying opportunity. So we made this recommendation at the beginning of December 2014, and December 2013. And you can see within literally over 30 days how rapidly the stock moved up, hit our 20% gain. That was our first target, and actually continued on for more than a 40% gain in about 90 days. So again, you could see the start of that elevator move. Now the stock broke down later on, but we already had taken our gain from that by that time. But you can see again, when you find these little stocks that are undervalued, these charts can move rapidly in your favor. So the quick lesson again is you want to buy the stock when the gap is negative. That's going to occur when the earnings growth rate is higher than the current price to earnings ratio. You'll avoid the stock when the gap is positive. That will happen when the earnings growth rate is lower than the current price to earnings ratio. So what you have here is the PE gap when it's negative is telling you that the stock is undervalued relative to future earnings growth. You're buying this stock at a discount relative to that future growth. The positive gap is exactly the opposite. You're paying a premium for lower growth. That's why you would want to avoid that stock when the PE gap is positive. So here's the calculation, here's the formula, here's how you put it all together. This is three simple numbers is all you need. This is American Airlines. Just from a Yahoo Finance, to get these numbers, we use Yahoo Finance mainly because it's accessible to everyone who follows us at the Millionaire Blueprint, and also because it's very easy to get this information and it's accurate. So to get there, you go to Yahoo Finance, type in a stock symbol, and then in the left-hand section there, the menu down at the bottom, you'll see Analysts' Estimates. And that will bring you to this page. That's what we're looking at. From this page, you need three numbers: the current stock price, the current year's earnings estimate, and the next year's earnings estimates. Now, obviously, in this example, we have a current price of $51.40, and then you see the two red boxes to the right. Our current year's earnings from this snapshot were $5.72, and the next year's earnings were $8.42. You can see right away that those numbers are very much out of kilter, so to speak, that the 2015 earnings are substantially higher than the 2014 earnings. So it doesn't take a genius to see that their earnings growth is expected to be substantial, or was at this time, from year one to year two. That's our first tip, that we're on to something. But the next step is to do the two simple calculations. The first one is to calculate your price to earnings ratio. To do that, you take the current price divided by the current year's earnings estimates. In our example, that's $51.40 divided by 5.72, $5.72. That gives us a PE ratio of 9. Now, again, fair value being 16, we know again that this stock is already substantially undervalued to the overall market. Next up is to calculate the earnings growth rate. To do that, you take next year's earnings estimates. So in this case, that would be the 2015 earnings estimates, or $8.42, and divide them by the current year earnings estimates. Those would be the 2014 numbers of $5.72. That would yield a 1.47 number. You subtract the 1 to get the percentage, in which case we would have 47% earnings growth rate. That's pretty substantial from one year to the next. The last step in this formula is to subtract those two numbers, one from the other. You're subtracting the earnings growth rate from the PE ratio. So the PE ratio of 9 minus the earnings growth rate of 47 gives us a PE gap of negative 38. Again, at this point, we know the gap is negative. It tells us that the company is undervalued. We're buying this stock at a discount relative to future earnings growth. So here's an example. We actually made this recommendation last fall at a time when American Airlines was trading at $34.50. Ironically, its PE gap numbers were largely similar to what we just ran with the $51.40 price. But this again shows you when you are jumping in on a stock at the right time. We got in at the beginning of October. We had to hold through a small period of volatility there. But within 30 days, this stock had moved up, hit a 20% target, and then kept on going, and it has since moved up. It's been obviously trending sideways with the overall markets based on oil. You really have flip trades there. Oil up, airlines down. Oil down, airlines up. That's what's been affecting most of the airlines in the sector right now. But you can see how rapidly, within 60 days, this stock hit a 40% gain from early October. And it's not like we bought the low here. We bought it at a good time. The stock was fairly valued to us. It was a big discount. And that's how rapidly these stocks can move. And another point to make here is, notice I'm not doing this with penny stocks or OTCs or junk stocks. These are good names. American Airlines is certainly a very good name. Delta Airlines was a good name. We've traded General Motors. We've traded Whirlpool. We've traded Goodyear Tire using this approach. So you can utilize this approach on the top end of the stock market. This is not really going to work very well with junk stocks or crappy stocks or penny stocks. So I wouldn't recommend it with that. I would focus strictly on big names, good names, and I'll share with you a little training program that we have here in just a little bit. So here's another example. This is Meritor. Meritor is an automotive supplier, stock symbol MTOR. At the time that we recommended this stock, it was trading at a PE ratio of 15. It had an earnings growth rate of 35, which gave it a negative 20 PE gap. So again, gap is negative, telling us that this price is discounted relative to future earnings growth. We have recommended this at the end of October, heading into November, and again, you can see this nice move very quickly. The stock jumped within 9 days. We had a 20% target hit, and it continued on going up for over a 30% gain into the month of December. So again, you can see that escalator move, and you're not always going to buy the first step on the escalator, and you're not going to always exit at the top step of the escalator. So all we want to ride is a portion of that escalator, take our gains, go home and repeat the process. You don't have to be greedy. You don't have to take stupid risks with your money. Just take a simple approach. This fundamental analysis tactic will help you find good stocks to buy and a good time to buy them. We simply buy at the beginning of the month and move on from there and target our gains. So again, when the gap is negative, you want to buy the stock. When the gap is positive, that's the time to avoid or sell the stock. This is a strategy that we use for stocks that can move between 20 and 100%, 150%. For the most part, our portfolio is predicated on short-term investments, so we're largely targeting those 20% moves and capturing those gains as frequently and often as possible. You will have stocks that will break down. You will have stocks that you may have to cut losses or preserve capital on. And typically, you'll find that those are instances where a company has reported a surprise, typically on the bad side or the negative side, in their earnings. It can be anything from missing earnings, missing revenue, changing people at the top. Obviously, the dollar has been negatively impacting multinational corporations in the last 4 months. Oil, obviously, the price of oil negatively impacting a whole swath of sectors in the stock market. So you'll have other factors that you have to take into account, but this one number will help you to build a little watch list, track that watch list, and keep moving on. So let's go back to Delta here real quickly. This was one of our most stunning gains using this approach at that point in time. We've had others, but just at that point in time. And I told you it actually had a PE ratio of 6 and a profit growth rate of 53 at the time that we recommended this stock, which gave us a PE gap of -47. The recommendation was to buy it on January 1, right at the beginning of the year. So original price was $11.87, and you can see we were out at around, we rode it up to $28.64, which is a 141% gain. And again, good stock, good name. Bought it at the right time. There will be many more opportunities. Just because we show you one, you don't feel like you've missed out on the opportunities, because there will be more. So the way to monitor these trades, once you've identified one of these stocks, you want to check earnings reports and or earnings estimates on a regular basis. Once a month is more than enough. You're looking for whether or not the company is beating, meeting, or missing its earnings estimates, its revenue estimates. These are simple. I mean, it's easy to see whether they are or not. But this is usually a good tip-off on whether it's a time to exit a trade or to keep holding a trade. You also want to check analysts' estimates revisions. You can find that on Yahoo's analyst estimate page as well. And look for whether or not analyst estimates are rising or declining. If they're falling, that could be a warning sign, and you may want to take gains and move on. If they're rising, again, that could be a precursor to holding a trade for a longer period of time. And then, so again, I think I just really pretty much covered this. If they're beating, meeting, or missing, these are really just the tips or tricks, if you will, for when to exit potentially a trade that you may be holding, or continue holding for larger gains. Beating and meeting, most of the time, those are okay. It's really if they start missing or if estimates are declining or decreasing. So the way to sell it, the way to make money on this, is always plan ahead. We use, as I told you earlier, for our short-term trades, 20% profit targets. When we hit that target, most of the time we're taking our gains. It's actually the fewer times that we'll hold on and target that 40%. But we plan ahead and plan to take those 20% gains as frequently as we can. Then we'll set profit and or trailing targets and stick to them. And again, if you see that PE gap change from a negative PE gap to 0 or to a positive, that's the time to make sure you close that trade, because something substantially negative has occurred with that company. So as we get down to the last 12 minutes, I'll try to leave a little time for questions here. Would like to announce a special offer today for our PE gap training package, $7.95. This is not a big sales event or a big pitch. So this will teach you in depth how to calculate the PE gap, but I include really a number of other things for you to use tactically and strategically so that you make money using this approach. First and foremost, you'll get a 45-minute in-depth training video. It also includes some basic stock screening tactics that we have found work. That's everything from daily volume to the size of the companies that you should be looking for, things like beta, other tactics. It's not a software approach. It's a way for you to instantly analyze a company and know whether you're buying growth at that discounted price. You'll see more examples on how to calculate the PE gap. I'll show you how to build a PE gap watch list in that training video. You'll be able to get my PE gap trading cheat sheet, which shows you how to capture those gains that I showed you of 20 to 100%. We also have a bonus Excel spreadsheet which does all of the PE gap calculation for you. So this goes right along with building that PE gap watch list, and we include all of the presentation slides so that you can follow along or refer back to them anytime you need. Again, that's $7.95. I'll put the link up here in just a second. I told you one of the things that we give you is our bonus Excel workbook, and this is an example of how it does all of the number crunching for you. So you actually don't even have to pick up a calculator, and I like that because I'm not a fan of calculators. But so here's some examples. You put in the current price, you put in the estimates that are necessary, it calculates the PE ratio, it calculates the earnings growth rate, and then it calculates the PE gap for you, and then you can simply sort this by negative to positive numbers. So you'll know instantly, you'll always have a little group of stocks that you can target for growth. If you're a short trader, you can also look at the positives and potentially have stocks that you might consider shorting. The second one is our trading cheat sheet. This, again, is how to target the gains based on the results of that PE gap. So the wider that gap, the better the long-term results of that. That's that long-term earnings growth forecast that you're looking for. Smaller the gap, those are typically used for shorter-term trades because those gaps can change much more rapidly. So this tells you what kinds of gains to target, it's about how long to hold, the length of the time, everything you need in one little sheet of paper so that you know how to approach it once you've calculated your PE gap. So we'll put the link up here in just a second. Again, everything you get, the 45-minute video, screening tactics, calculating the gap, building a watch list, the trading cheat sheet, the Excel spreadsheet, all my presentation slides, $7.95. Seriously, it's the best $7.95 I think you'll spend this weekend for finding new stocks. Here's the link, millionaire-blueprint.com/1. ONE1. That will get you to the order form to reserve a copy right now, and you'll have everything you need. This is a new approach for finding stocks that's simplified for you. It works. We've seen some of the examples. I want to drag out the question box here to see if I can answer a couple of questions in my last 8 minutes and try to keep you on time as usual. Let me see where I am here. Michael asked, gaps could take months to years to be realized. Not always, Michael. Good question. Again, a wider gap is, the larger that gap is, those are typically stocks that have longer-term growth prospects. And oftentimes what you'll see is, if you look down at the sort of quarter-by-quarter numbers, you'll see that the close-in quarters, sort of quarter one, quarter two, might have really small earnings expectations, but then all of a sudden quarter three, quarter four have substantially larger earnings expectations. So what that's telling you is you're getting in at a good time, but you are going to have to hold for the company to achieve those earnings expectations, and that's why you're you're backloading the growth rate. In other words, the power of that growth is going to come in the second half of the time that you're holding that trade. But if you're buying at a lower price today, that's when you want to buy it. You don't want to buy it when the company meets those big numbers and all of a sudden the stock starts to move from there, because you'll typically find you've already missed most of the move. That's when you wind up buying the high, because that's when mutual funds might pile in to grab a little gain, or the typical retail trader is following CNBC's news, what have you. You want to be in before Wall Street starts pricing that stock forward. Remember, the street is always pricing 6 to 12 months out, sometimes farther, depending on a sector, depending on a stock. So the prices that you're seeing today are the values of the stocks that Wall Street sees 6 to 12 months from now. So you've got to get ahead of Wall Street, and that's why even with a wider gap and a longer-term opportunity, those are still stocks that you would want to hold. How accurate are projections? That's a great question. Apple is a perfect example. Apple beats earnings estimates pretty much every quarter. So remember that these are typically, not always, but typically these estimates are produced by analysts who have no interest. Not all of them, but most of them are analysts that don't have a vested interest in the company or in necessarily a Wall Street firm, a trading firm. They are, by and large, you'll find that companies are going to beat estimates, they're going to meet them, and they're going to miss them, probably about 1/3 each. There's no way to say everything is 100% accurate. You're using the best information that's available to everybody. That's the key thing. These are not numbers that, it's not like everybody has a different set of numbers. These are the same numbers that everyone has. So you're working with the same information as everyone else, but you're using it in a way that's unique and most other people are not. That's the really big difference. Great question there from Michael again. No, we don't use company projections. Companies can either affirm or change guidance. Guidance is used by the analysts to develop the numbers, but it's not. We don't want their numbers. We want the analysts' numbers because, again, we want to remove. We don't want the company telling us what they think they're going to earn. We want the analysts telling what the company thinks it should, or they think the company should be earning. Let's see. How does fair value of PE at 16 factor in? It doesn't necessarily. It's simply a guideline for you. Again, if you see a stock that's at 8, you know that it's significantly undervalued compared to fair value. That tells you right away you have an undervalued company, but you have to balance that with the earnings growth of the company to ensure that you're not buying a company that has very, very slow or no growth. So the trick there is you're balancing everything between the fair value to the current value to the future value to the growth of earnings. But that's a great question. I guess Dave Fredrickson apparently had some problems. So do you have a current recommendation as an example to track? You know what? I got 5 minutes. Hang on a second. And I'll show you something right now. Let's hopefully you can all see this real quickly here. And I'm just going to throw this up. Let me know if you guys can see KOP. That's Copper's holding. I have to expand this window just a little bit for everybody to see. So this is actually a live recommendation that we made for the month of May. You can see they had a pretty good day on Friday, and we made this recommendation, entered at the market open on Monday of last week, so the first trading day, well, it was technically the second, but largely the first trading day of the month. Our entry price was $22 and I think it was $22.81 or 84 cents. I apologize, I don't have it right at hand. But again, here are the three numbers we need. You should be able to see $26.13, $1.66, $2.59. You guys are going to make me grab my calculator, so hold on just a second and we'll do this. So we have, first step is calculating that price to earnings ratio. So we have $26.13 divided by the current year's earnings estimates. So we're dividing it by this number here, $1.66. That gives us a PE ratio of 15.7. We'll round it up to 16. Next up is the earnings growth rate. We take 2016's number, 259, divided by $1.66, and subtract 1, and that gives us 56% growth rate. So we had a PE ratio of 16 and an earnings growth rate of 56. So we have a negative 40 PE gap. So there's Copper's, and since it's already up almost $3.70 some cents since we instituted this, so it's up about 14% altogether. For the current month, this was a recommendation we made for May of 2015, so this month. That's how simple this is to do. And you can see, again, here's your earnings estimates. So you can see they've had some negative surprises, one positive surprise. These are the EPS trends down here. This is what I was telling you earlier, to look for changes in the estimates for the year. These the revisions down here tell you when those changes have been applied. So did it happen in the last 30 days, the last 7 days? So you can see that 90 days ago, the company was expected to earn $2.32, and that's been reduced to $1.66. Number of factors for that. That's not necessarily a bad thing. You can see also their next year's earnings have been reduced from $3 down to $2.59. But these are some of the things that you can dive in and look at. Sometimes you'll see these estimates rising rapidly from 90 to current, and those are some good examples. So again, we're entering quite simply at the beginning of every month, and then moving on from there. So again, let me fire away here. Reed, did we get the link out for everybody? Make sure that everyone can see that. And again, it's millionaire-blueprint.com/1, and try and get this out here. But that's all the time that I have. I want to make sure we end on time for Reed. And so there you go, folks. Millionaire-blueprint.com/1. That's the complete PE gap training. It teaches you everything you need. It's a 45-minute video. Stock screening tactics, calculating the gap, building a watch list, the trading cheat sheet, the bonus Excel spreadsheet, and all of my presentation slides for $7.95. Everything you need, all wrapped up into one nice, neat little package.